Hey everyone, it's Matt Haraburda here at Bernardo Wealth Planning, Chief Investment Officer. I hope your summer's off to a great start. We just wanted to reach out with our review of Q2 and give our outlook for the remainder of this year. So Q2 was really a continuation of a lot of the themes that we've been talking about at the end of Q1, where you've seen a small number of companies really drive the vast majority of the returns within the equity market. We've continued to see the U.S. economy and the U.S. consumer remain strong in kind of spite of the fact that we've had higher rates for a long period of time. So why is that? So we continue to believe that there are several reasons why the U.S. economy has been so strong. First, the job market remains quite strong. So 4% unemployment is historically below the average levels. A lot of consumers continue to have fixed rate mortgages on their homes. And on the corporate side of things, those fixed rate debt that large corporations have, they haven't needed to refinance because they've locked in these lower rates. So there's not nearly as much incentive as them to go out and raise more debt. What they're able to do then is kind of take that money and reinvest into R&D, specifically within the technology side of the market. And that's exactly what we've seen, and that's where the vast majority of returns have come from. Also, last week at the end, we kind of got our third consecutive month where we have seen that that inflation continues to come down and not accelerate. So while everyone has been talking about the 2% target for the Fed, we believe that the more important thing to look at is the fact that we continue month over month to now steadily come down, where to the point where we think that there likely will be a Fed rate cut at some point this year. So what does this mean for portfolios? Within the equity side of our portfolio, we continue to have a preference for large cap companies. So you can see that's by and large where we have the most exposure there. The reason, again, we believe that those companies have fixed rate debt obligations, so they're better able to withstand the higher interest rates on the front end of the curve because they don't have nearly as much exposure, and they're able to take that additional capital and continue to reinvest it. That said, we have started to quarter over quarter invest in more the value part of the market and add things in small and mid cap, because we do believe over time, as interest rates come down, those companies will be more proportionally impacted in a positive way, where they're going to be able to not outspend so much money on their interest payments as they will on their own internal business. And then on the fixed income side of things, we continue to have a preference for investment grade credit within the public markets and private credit in direct lending in the private side of the market. And the reason for this barbell approach is that we believe that investment grade companies, they have strong balance sheets, and that's good current income for us. And then in direct lending on the private credit side, that's where we kind of benefit from there being higher rates in the front end of the curve, and we sit highest in the capital stack. So not too much has changed from Q1, which isn't a bad thing. And we look forward to reaching out to you guys later this year with our next update. If you have any questions for myself or anyone on the team, please feel free to reach out. Thanks and have a great summer.